Good evening, everyone. Welcome to the eighth episode of ICC BIZ Live. Today, we have with us a very eminent person, Professor Indranil Sen Gupta, Professor of Practice, Shiv Nadar University. His background is illustrious. He occupied C-suite positions in Merrill Lynch, uh, Bank of America, as well as senior positions in Kotak Securities and in RBI. He was the head of chief economist as well as the head of research. Dada, welcome to our show. So let's begin our questions on the economy. Now, let's begin with your brief description of the Indian economy. My question is that Indian economy apparently went through the temporary slowdown, but and we look pre-budget. We looked at the economic survey of this year, which said that wages are sluggish, but profit margins are high, raising concerns of income distribution, productivity, and economic stability. Naturally, came the budget and huge tax reliefs, so that consumption demand can drive the economy. What are your comments on the Indian economy?
So I think that the Indian economy is going back to its, what I would call the long run potential growth of around 6%. And, there was a time after COVID, latent demand drove up growth. And we think that, that is now over. We are also in relatively more challenging circumstances. Number one, of course, the Fed has paused and US inflation does not seem to be coming down, which means that real high lending rates are here to stay. There is a limit to which the RBI can cut rates at a time when the Fed is pausing at fourth quarter. This is even more so because the RBI has already sold over $100 billion, in spot and forwards. So it is going to be far more difficult for the RBI to take chances with the rupee. Secondly, we were uh, relatively positive on rural India because of the good rains during the Kharif season. If you look at the Rabi season that is before us, there is a problem in the Rabi wheat growing areas, which is the main crop. While overall rainfall is very strong, the rainfall in the wheat growing areas is scarce. Finally, the global economic situation is clearly very uncertain. We are not very sure about, the U.S. Tariffs that President Trump is introducing. Where will they lead? Clearly, they will have impact. The president himself says that there's going to be short-run impact. Let us see how short that short run is, and if higher tariffs lead to higher inflation in the US, that will make it even more difficult for the Fed to cut rates. So clearly, we are in a challenging situation, both domestically and externally, and it remains to be seen how each of these kind of play out.
Thank you, sir. My question is, it is no doubt a challenging situation, but even then 6% is much higher than other growth rates. Is government driving expenditure to boost aggregate demand and growth? And what is the view? What is your view on government capex and private capex? and overall aggregate demand. In fact, I heard one MD give a statement that I'm not very keen on capex given the dumping by our neighbor. I'm not taking any names. Is
Well,
it
we
utilization
are.
in the economy at 100%? What's your view at aggregate demand and capacity utilization?
So if you look at aggregate demand, it faces challenges from high lending rates, number one, and number two, fiscal consolidation. Now, clearly, it's not possible to run high fiscal deficits year after year, and just as high fiscal deficits supported demand for the last 2 3 years, the correction in that is going to face challenges for aggregate demand in the next this year and next year at least. uh, it's true that the government has, tried to support consumption demand by a variety of ways, including cutting taxes. But then overall, the fiscal deficit is lower. So, one component is you are giving money, but overall, obviously, you are contracting the fiscal deficit, which means that the fiscal deficit is going to be a contractionary force in the economy, as it was last year, this year. And this is something that is unavoidable because we are we cannot keep on running such high fiscal deficits. Now, as far as private capex is concerned, I think uh, there has to be more certainty before the private sector capex can kick in. The government is trying to put in as much capex it can, but then clearly, you cannot, keep on running high fiscal deficits for public sector expenditure because that has other implications. So we do not see aggregate demand as very robust in the coming year, given that there are, you have high rates, you have fiscal contraction, and you have an uncertain global environment.
We seem to be following neoliberalism, but when we were students, we thought we it felt that Keynesianism is what matters, and socialism is a bit impractical. What is the ideal policy? I mean, is there anything any policy as such ideal? I mean, what are your thoughts?
I think there is the ideology, there is rhetoric, and there is reality. And I think that successive Indian governments, whatever be their ideological moorings, have pretty much reacted to reality. So if you see the previous UPA government, which was probably much more demand driven, it also took steps to cut the fiscal deficit. If you see the present government, which claims to be more supply side, they increased the fiscal deficit when growth faltered after the COVID shock, and now they are reducing the fiscal deficit. So I think that beyond a point, the Indian government, whoever be in power, pretty much follow commonsensical economics. There is pretty much whatever be the ideological battles that go on, when it comes to hard nosed policy, I think every government responds to the needs of the time. And clearly, we had a big shock. There was a time we tried to repair that by high fiscal deficits, low interest rates. Beyond a point, as recovery came, we have to now reduce the fiscal deficit. And unfortunately, because of the Fed, we are not being able to reduce the interest rate as fast as our inflation would suggest. Clearly, we are running very high real rates. Policy rate is 6 quarter. Inflation is probably going to be in the 4 to 5 or around 5%. So, from an inflation perspective, a domestic inflation perspective, there's clearly sufficient headroom to reduce rates. But again, that runs up against the constraint of the rupee.
Sir, thank you. Very nice concept, common sense economics. I mean, this is something which industry appreciates a lot. I mean, rather than IBT or economics. Now, you raised the point of interest rates, and we have had also had a query from RBI. What should be the next step in interest rates? According to us, what is our wish list? Whether RBI should cut or maintain interest rates. What is your view on RBI next meet this RBI monetary committee policy committee meeting is in April. What are your view on RBI and interest rates next month?
See, I think the RBI can cut once more, but after that, it is left to the Fed. Whether the Fed is going to, cut further or not is what will decide the RBI action. A year ago, in fact, when I was in the markets, I had called for RBI rate cuts down to 5.5%. But at that time, the Fed was thought to be cutting interest rates fairly aggressively, and we had very, very high FX reserves. Now the Fed itself is, gone into a long pause. It seems our FX reserves are no longer as high as they were. So I think, maybe one more cut, and then the RBI has to wait for more favorable global factors like US inflation coming down and the Fed beginning to cut before it can move further.
Okay, now about FDI in India. We are getting data that FDI in India has increased last financial. It was 33.5 billion dollars now, and 26% increase. This current financial, it will end at 42.1 billion. But we are also in the markets. We are also aware lot of private capex is flowing abroad, and is flowing abroad, and because now it's a globally integrated economy. Investing abroad is not a problem at all, and rather you are more FDI is sought after everywhere. So I mean, why is private capex flowing abroad? I mean, again I am coming back to the demand. Is it to jump tariff barriers, or to cater to global markets, or Indian market is sluggish? Why is FDI flowing Indian FDI abroad? What are your views?
I think what has happened is that as Indian companies are scaling up, they are looking at more globalized operations, which is a good thing. Uh, I think one problem of FDI is also that there's a lot of private equity money that had come, and that kind of got uh, quantified as sort of FDI. And now that companies have listed, some of these private equity players are leaving. So I think this is natural market market dynamics. If you want others to invest in your country, beyond a point you have to let your country invest elsewhere, because it can't be a one-way street. So yeah, I mean, I think one shouldn't read much beyond basic commercial intentions in this.
Okay, sir. Coming to forex, the when we were students, we thought we could judge the market that RBI is having a calibrated fall of around 5% per year, so that depreciation is uniform and exports stay constant or maybe grow, and import cost doesn't start hurting that much. But recently, the fall had been very huge, and RBI had pumping a lot of dollars in the market to stay stabilize. And with it seems that markets are whether markets are shaky, whether equity or I mean this question is on the forex market. The markets are shaky with Trump 2.0, and currency risks are becoming higher again. What are your views?
No, obviously, rupee risks are higher now compared to 6 months or even 1 year ago, because the RBI has sold almost $100 billion spot and forward. So in the past, I think a lot of investors took rupee stability for granted, and that is no longer going to be the case. And the RBI clearly will have to buy back FX reserves, recoup FX reserves. So for the next few months and maybe a year or two, the RBI will have to prioritize rebuilding FX reserves over rupee appreciation. So from that perspective, I think the rupee will remain weak for now till the RBI has gone back to a reasonably comfortable position. If you see the data, the RBI's FX reserves shorn of the forward book are now probably around $560 billion or so, whereas optimal FX reserves are closer to the about $650 billion. So the RBI will have to buy back this 90, $100 billion in the next 1-2 years, and which can be easy if there is a risk on all over the world. But then if not, it will mean that at some stage you have to sacrifice the rupee to bring rebuild your FX reserves. So net, I think the chances are that at least for the next 1 year odd, the rupee remains weak.
So our efforts to bring up an alternate currency, BRICS currency, rupee, ruble trade, and all that we were reading about in the papers. I mean, all that will not materialize. I mean, given Trump 2.0.
See, I think even beyond Trump 2.0, we are a very disparate set of countries. The BRIC, there's China, there's us, there is Brazil and Russia. So I think it's not very easy for a disparate set of countries like this at various stages of their own development. Clearly India and China have their own issues. So it's not very easy to bring out a BRICS currency from that perspective. Furthermore, the sine qua non of a free, hard currency is that it should be able to float, right? But neither China nor India are in a position to let their currencies float at this point in time. So therefore, I think I don't think that the BRIC currency project was something that could have materialized in the foreseeable future. If you look at reserve currencies, it's true that the Indian GDP and the Chinese GDP are going to be far bigger than many of these countries like Japan, UK, and so on. But then again, they are also not going to let their currencies float, which is the hallmark of a free currency.
Right. So thank you. Understood. Now, as a professor, for the benefit of our audience, would you explain a bit on the forex derivatives, forward contracts, swaps, options? Are all these available in India? And what drives the premier Indian foreign forex market? Market. I mean, I'll leave it to you.
So yes, we have all these derivative contracts in India, and I think liquidity is something that you need to see at some in I think a very long liquidity is not that easy to get, but most of these the instruments are available in India, and anyone who wants to hedge, anyone who wants to trade these markets can do so. So I think that the forward premium obviously adjusts to expectations of the currency, but it is not necessarily a great guide to the rupee. I think the problem is that in the recent years, maybe the last 10, 15 years, all emerging market currencies have turned so volatile that it's very, very difficult for the forward premier market to kind of anticipate the swings that are happening. In fact, I keep saying that markets are now trading stories than facts. Maybe there's a rumor that something will happen, the oil prices will go up, the currencies move in a certain way. Trump 2.0, what he will do, what he will not do, the currencies move in another way. So I think that it's not so easy for the forward premier to provide a very robust guide to where the rupee will be as we go forward. But then, of course, it is what it is. So, for those who want to trade the forward premier, will have to take their own view. But then those who are wanting to lock in will probably have to just use the forward premier.
Trading stories were, but I thought equity markets were more affected by stories, but are forex markets also affected by stories? Question one. Question two is, as an importer or exporter, do I need anything beyond the forward contract? Swaps and options are really needed for someone who is actively playing in the forex market. I think so. If you am wrong, please correct.
See, I think the whole world is now trading stories. Every market is trading stories, right? For example, when have you seen the sort of volatility that we are seeing in the dollar ever before, right? I mean,
Really, very
the
true.
dollar, if you see, has been swinging, like a pendulum, like in the last 5-7 years. So that's number one. US bond yields are moving like sometimes 20-30 basis points in a week. Sometimes the market feels the Fed is going to raise, sometimes it feels the Fed is going to cut. I don't think that we have seen a scenario where the Fed has started cutting and paused. Typically, in the past, the Fed would raise 25, 25 and go on for a long time, or they would cut 25 and, baby steps or whatever you say for a long time. But this sort of jerky movements that we are now seeing, I think the fixed income markets have not seen. It's true that equity markets have traded stories in the past, but now I think we are all listening to stories. Yeah, you are right that if you are an importer or exporter, then forward contracts are good enough. You probably need swaps only if you need immediate liquidity in one currency or the other, but otherwise you can continue with forwards.
Thank you. Now, coming to Trump 2.0, every day we get some disturbing news. Today, I mean, there was a threat of Indian government will be forced to offer zero tariffs. So that reciprocal tariffs are also zero. Our tariffs are also zero. I mean, we have given PLIs and manufacturing bases. I mean, what will Trump 2.0, where will we go? I mean, at this tariff for our export, how much hits we will take? And another is the this is one question. Another question is that the only way Trump 2.0 can be controlled is if we start levying local tax on Amazon, who apparently engage in predatory pricing, and Google, Facebook, Tesla. Instead of giving them a smooth access, if we start creating trouble for them, they will in turn create help to control Trump 2.0. So, sir, your views.
So I think we have to wait and see, to what extent, President Trump goes in all these tariffs, because I think it doesn't seem very feasible that his central idea that we will raise so much money from tariffs that we will do away with income tax. That doesn't seem very feasible. These things were done in a very, very different world in the past. Number two, if you raise tariffs, you clearly invite inflation and interest rates have to be raised. So, given, for example, there is a forecast by the Atlanta Fed that, the US economy will contract in this very quarter. So we have to wait and see what happens. So that's number one. Number two is that for India to have specific country based tariffs is very difficult. And uh, I am not so sure that India can say that US is reducing its tariffs and we reduce our tariffs to zero. What about other trading partners? So I think that it's not great economics to see, we all tried all this administrative controls, selective use of tariffs, selective use of credit controls in the past, and it didn't work for us. It didn't work for the world. So therefore, I think we have to wait and see how it goes. And then there are domestic industries, if you which have grown on the basis of certain assumptions about the cost of landed goods, and if you suddenly radically change those, then the question is that what happens to those domestic industries. Finally, I will say that I am not at all convinced with President Trump's argument that tariffs will reduce trade surpluses. Trade surpluses emerge when one country produces what the other country needs. So if US were to produce what its own citizens need, the trade surplus would come down because they wouldn't have to take so much from us, and so on and so forth. So I don't think that you can arm twist trading partners into reducing tariffs or putting reciprocal tariffs. You have to see whether your own economy, you are able to produce that particular good at a competitive price. So the reason why countries go into you know surplus or deficit is depending on whether they are able to produce the good that the other economy needs, or whether they are able to produce the good that their own economy needs. For example, the reason we are in deficit vis-a-vis the rest of the world is we don't have oil. Now no
Yeah.
amount of tariffs is going to correct that, right? So
Right.
I think we need to wait and see where this goes before coming to any hasty conclusion, because we saw all this the last time round as well, and it's not as if that is something that was very doable beyond a point, sustainable beyond a point.
Very common sense economics are very, very thankful, really eye-opening insights, really. But again, very basics. Something which is not in my area, not in my forte. I have to import it. That's true. That's true. Now, next question is on the debt market in India. We feel that the analysts, I mean, we meaning analysts, feel the debt market has really not taken off in India, be it corporate debt issue or government bond issue. Or is it more, uh, or is it not taken off at retail level? I mean, what is the view on the debt market in India, or is government bond issues only subscribed by banks? What I mean, what is your insights on debt markets?
So first, let's take the retail part. It's true that there isn't. It's true that retail is not necessarily buying government debt directly,
Yes,
but then
yes,
retail is investing in guild schemes, retail is investing in balanced funds, and so on. So if retail invests in guild schemes, I think that is good enough, because I may not have the time and the knowledge to trade the yield curve, the tenor of the yield curve. So I put the money in a guild scheme run by some mutual fund, and you are still getting retail savings. So I think that beyond a point, yes, maybe a long 20 years ago, retail participation in the GSEC market was an issue, but now with the emergence of guild schemes, guild funds, and so on, I think it's far less of an issue. The emergence of the corporate debt market is is something that we have not been able to achieve after 30 years of trying. That's true. uh, I think that initially it was because we were restricting, opening up our GSEC market to foreigners. So, the corporate debt market lacked liquidity. Personally remember, I had once marketed in Japan, and they said that, look, we do want, to buy Indian debt because India offers a very high interest rate compared to that of Japan. But then we cannot be buying such small volumes. We need to buy much larger volumes. So, given that we have always constricted the GSEC market, that has also meant that, big players have not come to the corporate debt market. And even if you see the corporate debt market, it's largely OTC. There isn't the sort of trading that happens in corporate debt markets in other countries. Now, I think the government and the RBI have taken several steps. The bankruptcy code filled one of those gaps. Of course, then the NCLT came, and I think it was overdone and now has had to be scaled back. There is the India is now listing in JP Morgan bond index and so on. So at least the old argument that when I used to meet fund managers in Singapore, London, and so on, they used to say that the problem is that if I lose money on corporate debt in India, my investment committee tells me that their GSECs are not on the benchmark. Why did you go and invest in India? So you are investing in India out of your own risk. That's the second issue. The third issue is that because of the withholding tax, etc., many people want to buy India-linked bonds, issued by the Asian Development Bank and so on, rather than buy, Indian bonds. Fourthly, I think somewhere we need a sovereign yield curve. As you know, the union budget did propose floating sovereign debt a few years ago, but that was later, recalled. The problem is that, maybe in 1 year you will get $10 billion. So for the first 3-4 years, the sovereign yield curve will become hostage to one big investor entering or one big investor leaving. Right? I mean, if you are just $20 billion or $30 billion, someone puts in $2 billion or takes away $2 billion, your sovereign yield curve is going to dance around, and as a result, you will see that your whole, the whole GSEC yield structure will be impacted. But at the same time, at some stage, we need to do this because otherwise, we'll not be able to develop a corporate, bond market, which India needs. Because ultimately, India's problem increasingly is becoming that we do not have a market for project finance. In the past, there were these DFIs, development financial institutions, but they couldn't take off when the yield curve flattened. They all, ICICI, IDBI, they all converted into banks. There was a time we tried to fund infrastructure through banks. That also had fairly disastrous consequences. Now we have, floated, NAPFID. But the point is that if your 10-year is 6.7 and your one-day money is 6.25, why will anybody give you long-term money? So I think first, our yield curve has to, steepen for us to even think of raising, long-term money through corporate bonds or anything else.
Too good an answer, sir. When I go as an ordinary investor to the bank, he will not understand all this economics. I will get an interest rate of 7.5% for 1.5 years and 6% for 10-year FD. And this paradox, I as an average investor will not understand. I would understand only for the higher yield, let me keep it. But how is the bank gaining out of it? I will not understand, and I would obviously look for a good return over a longer time. That gives me mental stability. Can you explain?
No, what are you saying? Sorry, I couldn't.
My question is why are short-term interest rates offered by banks are a little bit on the higher side because they apparently have a liquidity crunch. But long-term interest rates are very much on the lower side, as if they don't. If I offer long-term funds to them, they don't need it. So why these banks are welcoming short-term investors and not the long-term ones?
So I think two reasons. Number one is that I think everyone expects that interest rates will fall. So therefore, the yield curves have flattened, right? People think that maybe 6 months down the line, 1 year down the line, the yield curve will come down. In interest rates, the RBI will cut interest rates. So if you look at the 10 year typically is about 100 to 150 basis points above the short term, the call money rate. Today it is hardly 50 basis points higher. So the market is clearly pricing in lower rates at the longer end. So that is the primary reason why interest rates at the longer end are lower. The other is the lack of liquidity. You see, what was happening is that the RBI was selling dollars without pumping in rupee liquidity. They have only recently started doing open market operations and so on. So there was therefore a credit crunch at the short end. So therefore, both ways, the short end at higher rates, there was a credit crunch. This is what has driven up interest rates at the short end, and I think the market is expecting that somewhere down the line, sooner or later, the RBI will step in both with rate cuts as well as more liquidity. Therefore, the long end is not reacting, or actually is flattening. Long end is actually coming down relative to the short end.
But banks have to lend in the long run, no? Home loan or consumer loan or corporate loan. If they have a if they offer low rates in the longer end, will they get long term funds? How will they get long term funds?
No, the home loans, they are priced fairly high because the repo rate is high, and we are now in the world of EBLR, right? External benchmark linked lending rate. So if the repo rate is high, your mortgage rates are relatively high. This problem is more on the deposit side than the credit side at this point in time.
Now, before I go, we open the floor to questions. One more question here is people are rather going to stock markets and mutual funds for higher return, and also here people are saying that this is the ideal market to buy, and also the new income tax saving the uh, uh, it does not link in any of the savings to tax reliefs. So as if all the its saving schemes have to fight among each other to earn people's savings. So the common view is that liquidity problem will stay with banks, and people will go to keep going to stock market. If FIIs leave, Indian investors will more step in. What are your views?
No, I think that to begin with, there is no relationship between uh, bank liquidity and going to the stock market. Look at it this way, that if you own a fixed deposit and I own a share, you buy the share from me and I get your fixed deposit maybe in my current account. So what is happening is that because we are trading shares, maybe even
हाँ,
the
बोलो.
market is going up,
Question.
but the total
But
deposits in
question
the
is,
banking system are not changing. What was my your fixed deposit has become my casa, current and savings account, current account basically. So I think that it is not because of people going to the stock markets that we are seeing slower deposit growth. We are seeing slower deposit growth because the RBI has not infused liquidity, and despite selling so much of FX.
okay, sir. Now I would like to open the floor to questions if there are any questions.
So I think that it's best that you talk to your CA or income tax lawyer to learn about the rules. You can, yourself learn about the rules if you look at the budget documents, but I think it's much safer that you seek professional advice through through your chartered accountant. I think the short-term investment goal has to be capital preservation. We are in very volatile markets, and obviously the broader market has corrected. We don't know where the Fed is headed. We don't know where President Trump is headed, where the U.S. Stock markets are headed. So I think it's best to play safe in the short run. If you are the sort of person who wants to be in equity markets, it's best to be in large caps. If you are okay moving, somewhat to debt markets, then I think it's better to be in debt markets. I don't think yields are going to fall too much. Like I said, that the historic gap between the 10-year and the call money rate is 130 basis points. Right now, it's down to 50 basis points, which means that the market is already pricing in at least another 1-2 rate cuts. So it's not as if bond yields will fall further if the RBI cut rates, like if the RBI cuts again 25 bips or whatever, just as they have not fallen because the RBI cut rates in the last time round. But at least you will not lose money the way you are losing money now in the equity market. So I would strongly suggest that a defensive position at this point in time, because it may well be the case that there could be more pain to come. No, FDs are, whether you buy FDs, whether you buy government bonds, they pretty much pay similar. So, it's you could do either.
Shantanu, if you are there, any questions to our senior? Else we will wind up for the day, and any questions I get in future, I'll forward to sir. Okay, sir. Then it seems there are no more questions, and I'll wind up for the day.
Thank you.
Thank you, sir. Thank you very, very much. So it was very, very educative. Thank you.
My pleasure. Thank you very much.